Joining us now is Martin Pelletier, the portfolio manager for Trivest Wealth. We were just chatting, and Martin, you told us a line that I thought was so unique, so kind of quintessentially Canadian. I gotta hear the whole story. You were telling us that your ancestors came to Canada almost a little more than 350 years ago. And why don't you tell us that story? And welcome to the show, by the way.
Oh, thank you for having me. So we've got some deep roots, deep French-Canadian roots. I'm a direct descendant of the first Pelletier family that came to Canada in 1647. Now, coincidentally, I didn't mention this to you, but there's a line of risk takers and ADHD within the family. The first person that was guillotined in France happened to be a Pelletier as well, so we're a little bit of troublemakers. But so there was a father and two sons that came over, and the story was that the two sons had a bet to see who could get closest to the waterfall without going over. And my direct descendant of the one that lost the bet, because the one that won actually went over the waterfall and died. So even though we have some ADHD within the family, we certainly have a little bit of common sense as to how far to push it.
That's a great story. That makes me laugh. So why don't you tell me a little bit about yourself, where you went to university, and how you got your start in the business?
Yeah, so I always had a passion about investing from a very young age. Do you guys ever hear this? I'm not sure what vintage you are or not, but I'm Gen X, and there's this great board game, and I really suggest see if you can pick one up used online. It's called Stock Ticker. You guys ever heard of it?
No, I've never heard of it. We're both Gen Xers. We're like,
but I didn't heard of it.
Yeah,
I've never heard of Stock Ticker.
No,
awesome game. So it's a game that you have a peg, and a peg for oil, a peg for grain, a peg for stocks, a peg for bonds, and industrials, and so on, and so on. And so you roll the dice, and it goes into positive territory, and then you get a dividend. If it's in positive territory, it rolls into negative territory, you lose a dividend, but you could buy and make money on capital gains just based on the dice. And that game really,
that's awesome.
It's a great game. And I got my youngest boy when he started playing when he was 9, and he took $1,000, turned it to $50,000. So he's my next PM that I'm going to be hiring. But it's a great game, and so I always had a passion from investing from an early age. I started trading when I was a teenager. I did terrible. I picked stocks by their cool sounding names. So I remember the first stock I bought was called Valdez Gold. I had no idea what it actually, how much gold it produced, or even if it did produce gold. But I wish that I had, found Briex to be exciting name, but Valdez was more exciting to me at the time.
It's funny, Martin. I'm going to just interject because Briex was one of my first investments, and it's still actually on my wall. The certificates, nice. I have them framed. It's anyway.
I don't think you should say nice, because I think he wrote it all the way down to zero. If he's got the certificate, that means it's worthless and that he didn't sell, Martin.
Anyway, Martin, go on.
You should buy an Oldsmobile and get Matthew McConaughey to sign it, both the Oldsmobile and the Sears certs.
That's right.
All right.
Yeah. So anyway, I got into investing, and I really enjoyed it. I was the youngest person at the time to write the Canadian securities courses. I was 17 or 18 at the time. So it was kind of geeky, but it was kind of fun. And so I did that, and then I worked in during my summer jobs. I worked in the bank. I'd go in for the branch. So imagine this young whippersnapper who's 19 years old, sitting in the branch manager's office while he was on holidays, and making bank loans and mortgages, and just kind of winging it. So it was that was quite the experience. Until we got robbed and I had a shotgun put to my head, but that was a different story.
Oh, okay, that's a different story.
So that made you go into investment banking.
That made me, it's a bank. Maybe there's a sign from above that, this is just too dangerous for me. So, why not take it a step further and go to iBanking?
Right.
And, but anyway, so I did that and went to university, finished my university, met some Swedish girls, and I said, you know what? It looks like a nice place to visit. So I went and did some international business over in Örebro.
So basically, you went and chose your next university, your grad school university, by the girls that you were chasing?
Sometimes, things just happen, or,
I'll take that as a yes, Martin.
I actually met a Swedish girl and lived in a hippie colony in Cadiz and surfed. And
oh, God, that's got to be cold surfing in Sweden.
No, in Spain. I met a Swedish.
Oh, you met a Swedish girl and went to Spain. That's a lot smarter. Okay, and so and that's where you surfed. Okay,
it's all about diversification, right?
That's right.
And so I did that for a while, and I became a pretty good surfer, and then ran out of money. I had my parents sell my car for me, and I ran out, spent that pretty quick, and so I get back to reality. And so I started interviewing for jobs. And invest. I was looking at anything on the buy or sell side, and then I got into the sell side. Coincidentally, met another girl who ended up being my wife, and took the job in Calgary. So that's where I landed, and I've been here ever since.
Right. So you come back to Calgary, and so who do you work for in Calgary? And what's your job? Are you an investment banker, a research analyst? What are you doing?
So I got into capital markets as a research associate, worked at two firms, worked my way up into an analyst and senior analyst, and in energy. I didn't really. So the funny story, how I got the job. I was interviewing, and the first interview, they got my resume mixed up with a good buddy of mine, and his resume was stronger than mine, and it was similar because we both went to Sweden and chased girls. And so I got in based on his resume, and then I wined and dined them through my interview, and then I told him, I said, at the end of the interview, I said, by the way, I think you've got my buddy's resume mixed up with mine, and the rest was history.
Well, and we should say that first firm was Griffith McBurney, right?
No, so I started with Canaccord as an associate.
Oh, you did? Okay.
I did, and then I moved over to GMP. Because it was a firm that was leading in energy, and then.
Right, but I was just gonna laugh because I was gonna say Canaccord probably admired your hustle by not saying anything about the fact that you got mixed up, and they're like, "This is our kind of guy." He milked it for everything he could get.
I give young people advice on this when it comes to interviewing. I did a piece on a company called Anderson Exploration. And my cousin was the geologist there, and so I spent a whole week going through the company and analyzing the company. I didn't know much about energy, other than my dad working in pipelines, and so I really hustled for a whole week. And I wrote a report on a whole sell-side report on Anderson, and I actually provided some insight to the analyst that he didn't even know about the company because I spent a thorough amount of time going through it from the bottom up. And I mean, it wasn't the best well written, but it was showing some initiative. And all kidding aside, I mean that was the final decision that got me into the business. And so I really recommend that young people, when they're getting into the business, try and find something unique, a different way of demonstrating that you can learn a lot, and that you can learn a lot in a short period of time.
Right. Okay, so you're at so you start at Canaccord, you go to Griffiths, and then eventually you go back to Canaccord. You do your stint as kind of on the sell side as a research analyst, but we all know that the research analysts back in those days were more like investment bankers. But we won't go there. And then eventually you go and you decide you want to start your own hedge fund. What's the timing of that, and how does it work?
Well, it was tough because I was working 80 hours a week, but I was 33, 34 years old. And when I left, I was making $1 million a year. And so it was tough. It was a tough decision. And, but it just, I had two kids, and I saw the damage it was causing to families. And so I decided to pull the ripcord, and just coincidentally, that was July of 2008, Stampede. So it was a good time to quit. And then the market just fell apart. And so that forced me to think about what I wanted to do with this in consulting. But my heart was always going back to that stock ticker. My heart was always in the buy side. And so I started a firm with a partner of mine, and he was on the buy side. He was a client at Cypress Capital and More Investment Management. And so we started up the firm. and we did, a multidiscipline, global diversified approach. But it also gave me a chance to set up a hedge fund for energy, doing long, short, and doing a lot of derivative work. I know you guys do a lot of option work, so given the volatility in the sector, it was a great place to do some option strategies on. And so I did that, and then 2014 hit, and I'm like, this is a game changer, a real big game changer. And it's time to shut this thing down, and we did, and we focused entirely on our global family office approach.
Right, and for those who don't know, that's when oil really shit the bed, and went from $100 to 20 in the space of
26,
like in the space of
you had
like 6 months, 9 months.
Yeah, no, it was 6 months, and then it went back to 50. I mean, it's been yo-yo since then, but the U.S. over a 10-year period took oil from 4 to 10 to 12 million barrels a day.
And so
what's even worse was the Canadian West Texas, the
WCS
oil sand oil was just like dumping. It was down into the teens, wasn't it?
It was pretty low. Martin, and so at that point, did you think that it was you said it was a game changer? Did you think that the world had forever changed in terms of energy? And walk us through that thinking, maybe like what you saw and why you decided to transition out of energy and into kind of traditional, I wouldn't call it traditional, but just kind of high-end money management.
Well, okay, so if you're in energy space, you're in a price taker market, and I don't like price. I don't like being a price taker, and I don't like a market that's commodity. I don't like a commodity type of market because you're so susceptible to disruption of both demand and supply, but more so in the energy space on the supply side. I mean, coincidentally, I was a young whippersnapper. I was traveling around the world with guys like Henry Groppe, who was an advisor to the Bush administration, and telling guys that peak oil was here, and no, there's never been new technology that's been able to crack open unconventional reserves. I mean, it was just a total wrong thing, the wrong story, but people were buying into it. And so I always try and question myself and talk to people who think differently than me, and question my own thought patterns just to see where I could be wrong, and then how do I adapt. And so, we saw a wall of oil hitting the market with shale. Horizontal multi-stage fracking was a game changer, but more so, I started to see some of the technology, the data technology being applied to unconventional reservoirs, and that's what's really concerning. I mean, you're applying downhole sensor technology, automated drilling, and artificial intelligence to optimize recovery rates by 3 to 4%. Doesn't seem like much, but that's huge in the oil business. And suddenly you have as much oil as you need. At the same time, you have a global, stagflation environment where you're just not seeing rapid growth in demand for crude oil. Still seeing growth, but not rapid growth. Forget about the whole EV thing; that's garbage. But you have as much supply as you need, and so I'm like, this is not a situation where you want to be long for a long period of time. It's and there's capital leaving. That's the other thing too. So liquidity is my golden rule, and so you're fighting all kinds of things. So you're better just to get out of the way.
Okay, so you get out of the way and you go and you start like a private wealth management business, and catering to kind of high net worth individuals. Is that the long and short of it? And do you specialize in any one part, or is it just basically whatever it takes to cater to their needs? And what have you learned as you've gone and made this transition into a different part of your career?
Yeah, so the understanding the last decade has just been phenomenal. Like the pace of disruption because of connectivity is unprecedented, and it impacts every single sector. And you're crazy if you don't think it doesn't impact markets, it doesn't impact wealth management. I was hanging out with a former iBanker the other day. Trading desks on the iBanking side have been decimated, because you have compliance and guys are moving away from stock picking. I wrote an article about this for next week. They're going more towards outsourced models and ETFs. And so, now all of a sudden trading and sales and trading isn't worth anything on the sell side. On the wealth management side, ETFs have commoditized and democratized the entire business, good or bad. And so as a result, if your traditional way of starting a wealth management firm is by creating an in-house product and marketing said product, now you're in the low-cost manufacturing space, and you need size and scale. So if you're under $1 billion in assets and you're creating products, it better be sure as heck be a really, I don't know. Even still, it's not a business I want to be involved in.
Okay, so you go and you start this wealth management, and what are the things that you kind of like? What are the kudos that you live by? Like, what are you offering to the investor that is different than what you get from like a Royal Bank or a CIBC?
Yeah, absolutely. So McKinsey did a really good report, and again, I'm going to be right. I wrote about this for next week, so you're getting a little bit of a snapshot of it or a prelude. You look at the value of the advisor and the value of what someone's going to pay you for. They're not going to pay you to pick Bell or TELUS, okay? You could pay for advice for you to do that yourself. It's a whole different. I'm not talking about the do-it-yourself investor. There's a huge need for providing services to those do-it-yourself investors, and whether it be options or whether it be stocks, that sort of thing. I'm talking about someone who doesn't have time to do that, someone who's $5-10 million bucks, got a family office that want to generate X return for their operations, whatever the case may be, whatever the goals are, and so they don't have time. And so the value proposition is in getting working on this something called goals-based benchmarking. So it's identifying what specific goal that family or individual wants to achieve, and what rate of return do they need to generate to achieve that specific goal, and then how do you customize a portfolio to achieve that return and minimize the risk. So you're not trying to beat the market. You're not trying to so your benchmarking is based on that specific goal. So if it's 5 or 6%, how do we do that and take as little risk as possible? And you can do that through proper portfolio construction, risk management, multi-strats, use of some alternatives. Like we have a whole process that we use to custom design portfolios based on that specific goal. And that's a future, like that's happening in the U.S. at a record pace. Guys are leaving wirehouses, setting up U.S. RIAs. They're using TAMPs or using managed platforms that are world-class managers. Like you could buy, I don't know if you knew this, but Vanguard does active mutual funds and is getting into private equity.
Yeah, no, I did know that, but I think a lot of people wouldn't know that. They have actually, I think, believe it or not, I think they have more assets under management that are active than passive.
Yeah. So
maybe I'm wrong. Maybe I'm wrong, but like it's some crazy number. Yeah, like it's a large. Yeah.
You can get access to Wellington in Boston. There used to be a client of mine, really smart guys, good guys doing some good work there for 50 basis points. I mean, that's just outstanding. I mean, you normally had to write a check for $5 million to get that. Now you can just put, $1,000 or $2,000 in it. Now you're getting Wellington managing your portfolio. I mean, it's just outstanding. Right.
Right. And so those are kind of public market managers. Have you noticed a real trend towards the private markets and high net worth individuals clamoring for private debt and private equity and other things like that? And what do you think about that?
Well, it concerns me because there's been so much demand for it that the illiquidity premium's gone. So, I mean, people don't realize the value of liquidity, right? I love liquidity. Right. I love being able to hit a button and getting my money back. I love it. Fantastic. It's wonderful, right?
People don't really understand, and they've forgotten it. And I was actually, someone told me the other day about a private kind of real estate manager that they had assets in a private fund and a public fund, and the private fund was actually trading at a premium to the public.
Oh yeah. So I mean, people are paying to get rid of their liquidity. It's insane. And but if you okay, how about I tell you this? You invest in a public sector portfolio, or I can replicate privates through a levered small cap portfolio. But let's just say I do a regular one. I'm not going to mark the market for you, and your money's locked in for 5 years.
I know. It's funny. It's almost the same return. It's probably a better return profile.
Oh, it's better. So Cambridge Associates did a study, and they looked at public REITs versus private real estate. The biggest study, 900 funds, and and over 25 years, REITs outperformed by 4% a year.
and you had the liquidity.
Yeah.
Right.
So there's a whole section.
Okay, so walk us through. So what do you think's happening, and how do you think that ends?
Well, it doesn't end well when there's some sort of market event, right? I remember that. I mean, I'm sure you guys do too. Guys are trying to gray market their stuff because they have to market it. They have to mark to market it in their portfolio. So they're trying to gray market it, and they don't even know what the value of it is. And then you've got leverage involved in private equity, and then it's a disaster if you don't do a proper job. Now, in portfolios, having direct investments is not we run some very big clients, and we have one client with $500 million of private assets and direct investments, and they have a whole team looking at their real estate that they're doing and how they're developing. That's a whole different story. It's a whole different story.
Right.
Buying a pool of mix that 500 mix that pay you, hey, I'm getting 8% on that. I mean, where's the common sense? I mean, you can go get a mortgage at 2 or 3%. Who in the hell is paying 8%? And then you're telling me that it's low risk
on it too. Yeah, no, you're absolutely right. Okay, so let's talk about the what you see in terms of the Canadian market, and you're an energy specialist. Do you see the energy continuing to just, I don't know, like just continue to stink? Like, is there ever going to be a bottom for these energy stocks? Like, I see that Eric Nuttall is probably the last and only remaining Canadian energy fund left, and I think he said something that he might be one of only 2 global energy.
I think Rathia Canoe is still kicking around. So
so there's 2 of them. There's 2 of them.
Yeah.
But you think back to your days when you used to cover these guys. There probably was 20, 40.
Oh, no, there was more. It was unbelievable.
Yeah, and now there's 2 guys. And whenever I hear that kind of number,
$1 million a year. I mean, we were getting and that wasn't just me. There was a whole bunch of other guys too. So it was big.
But when you start to see 50 down to 2, you got to start thinking maybe there's a spot where I should be buying as a contrary investor.
Well, you could have been doing that for 6 years now.
Okay, so
right?
talk. I take it by the sounds of it that you're a bear on energy and energy stocks. Walk us through why they're not, why they're a value trap, which is what I'm assuming you're gonna say.
Yeah, because until we start to see fiscal spending become a pervasive theme, that we start to see inflation creep into the market, these commodities are going to continue to go sideways. Right? There's day trading stuff. I mean, you can make some trades on these things. You can, but the model is there are some unbelievable value in the space. You can buy some energy companies that have a 6 to 7% dividend and a payout ratio of 90%. And I'm like, that's a great model. You need to adapt and pay out, minimize your sustaining capital, keep production flat, and pay out as much as you can, or do share buybacks. So financial engineer yourself. Don't put it back in the ground. So eventually, there's going to be a day that there'll be a supply reaction, but that could be another 5 or 6 years. And so,
okay, so actually, what would you own if you were assuming that supply reaction was sooner than you think, and you were trying to find companies that fit your criteria that you just mentioned? Can you give us some names?
Okay, so size, manufacturing, low cost. The sector's been disrupted, so you need to own a low cost manufacturer. So we own Suncor, we own Exxon's. I mean, it's not exciting, but I'm getting 6% dividend, and those things will torque. I mean, Exxon's off 35% in the last 12 months. So, I mean, from a risk reward standpoint, names like those are good ones to own. Now, like we view Canada, so in the last 10 years, I've diversified outside of energy. So it's been a good learning experience for me. So I've got as much experience outside of energy as I do within energy now. And so I've taken the lessons learned from that. And so you look at the Canadian marketplace as a whole, and you can see it in what happened in the energy space collapse. We're a culture of complacency and a culture of entitlement. What I mean by that is we don't know how to compete globally. We operate within oligopoly type structures, and that's Energy's moved towards an oligopoly structure, CNQ and Suncor, Cenovus, that's it, right? And then CNRL. Within banking, you have the banks. Within telecom, you have the telecom. So they're not high growth stories. They're dividend type of stories, but not high growth stories. So if you want growth, you're going to have to get it outside of Canada.
Okay, so you're a seller of Canada. Now, yeah, for sure. Now, listen, you mentioned something that was near and dear to my heart. You said something about the fact that until we get fiscal spending, we're not going to see any inflation. And I 100% agree with you.
Yeah.
I happen to think that fiscal spending is going to be sooner rather than later. But why don't you walk me through your thinking and what you've come to terms with? Because I'm assuming you've realized, that monetary stimulus no longer works, and that fiscal is the only way to actually create the inflation that we so desperately want.
100%.
So why don't you walk us through your thinking?
Yeah, absolutely. So, just putting the fiscal thing aside, monetary stimulus is driving markets, and you can see it. That liquidity is working its way into the S&P. When they took it away, it hurt the S&P. So if you're going to follow anything in the public markets, you got to follow that. In Canada, it's funny because that monetary stimulus didn't work its way into stocks; it worked its way into housing.
Yeah, I 100% agree. Yeah, you're right.
Yeah, and that's why Bank of Canada is in a really hard position because they would like to lower rates, but they can't because of the housing market. And so anyway, that's a whole different story. But looking at fiscal, where your question is fiscal spending. Because that monetary stimulus has not worked its way into the broader economy, right? We're not seeing economic benefits from that for the average person. Okay, so the gap is widening between the wealthy and the poor. So in the U.S., there isn't a lot of people that own stocks per se, and so they haven't benefited from the rally in the equity market. And in Canada, there isn't a huge amount of people that own houses. It's actually worse in Canada because now you have all these speculators going crazy in housing. It's hit people who didn't participate in that. Now they have no affordability, and so governments are they're pushing hard, and we can see that by who they're nominating on the political spectrum. So guys are going more left wing. You're seeing that in the U.S. With the Democrats. You have people in Canada. You're seeing with Trudeau, he's more of an NDP than liberal, and so you're going to see fiscal spending get ramped up to try and help out. And help narrow that gap. And when you look at real GDP per capita in Canada growth, it's zero in the last 5 years. And so, they're going to ramp up spending. And I think it's going to happen the U.S. is already doing it. Canada is going to ramp it up. Black zero is the big question in Germany. Is Germany, their economic numbers are terrible. And,
their economy is in real trouble, and even the Schäuble, who is the architect of Black Zero, has actually recently come around. Don't you think that the climate, whether you believe it or not, and I don't want to get into all that stuff, but don't you think that that's going to be the excuse that they need to spend?
Yeah, I do. I think this is a turnaround. But that's why I was a little bit bullish on energy starting the year because I'm like, I got a position around this, right? Then this coronavirus thing hit, and I'm like, shit, this is not good.
So let's just separate that before you go on to the corona. So, so you were basically positioning yourself for a reflation due to the fact that we were going to get fiscal spending. Is that correct?
Yes, I was starting. I started to see some green shoots of that trade coming out, and so we started to pick away at those segments of the market that would benefit from that, and that would be energy. And then Corona hit.
So let's talk about that because the fact is that the market seems to be like a lot of people are confused about the reaction of the market. Why don't you give us your interpretation of what's happening? No,
I'm
so walk us through. Okay, so what do you think is happening?
The market is disconnected from the economy, and that makes total sense. If you haven't caught on to that, then what are you doing? It's been staring you in the face for a decade. People have always been wondering. You can read Rosenberg, and he's going to tell you all of this negative economic news, and you've missed out on all of these gains. It's liquidity. It's a path of least resistance. Liquidity, Fed liquidity. That's what's driving the market, driving equities. Is going into those riskier parts of the market, including equities, irregardless of the economy. And so,
okay, I would actually even add that we get PBOC liquidity based on China. Would you agree?
Yeah, I would agree.
Right. So your contention is that even though the coronavirus might be worse than than at least it appears with the market reaction, you're not confused by it because you think that this is a disconnect between kind of economic fundamentals and risk assets.
It's going to have a positive impact on the market because it's going to get these central banks to pump even more liquidity in the market, right?
So,
like, who cares about the economy? It's all about liquidity in the market, right?
So how does that end? Because I mean, okay, so let's play this out.
Ask me how it ends. Like, you could ask me that.
No, but
11, 12, 13, 14, 15.
But
16,
let me ask you something. So it continues. So it basically, every bad news is good news because all bad news basically drives more liquidity, and more liquidity drives stock market higher. So let's say then the most bullish event could be, let's say, Yellowstone Park blowing up. Hey, you know what? Half of North America is covered in ash. That must be bullish because they're gonna do a big stimulus spend, right? No, but like the point is that you can make an argument that every bad news is good news because everything is going to lead to. Okay,
there's going no. So like
okay. Maybe I'm ranting, but give me a.
No, I'll give you a story because I'll give you a story. There's going to be something that's going to be a catalyst that is going to be that we don't know, that is going to be large enough to offset the liquidity being provided by central banks. Like, there's going to be something, and I don't know what it is and when it's going to happen. There's going to be something, right? And maybe.
And so do you think coronavirus, if it truly went global, could be that?
Well, maybe. But it's the hard part is with social media and connectivity, we don't know what the truth is. We really don't know what the truth is, and so. That's a problem. And so, I mean, I think it's going to be something that we don't see coming. So going back, do you guys know Morgan Housel did a really good story on this? And do you guys know Morgan Housel at all?
Yeah, I follow him on Twitter. He's a writer.
He came out for the CFA dinner and he told me this story. It's really cool. Do you guys know how Harry Houdini died?
No. Did he get into a trap did he get into a trick that he basically screwed up on?
No, I mean, everyone thinks that would be it. But so he used to go around and he used to tighten his stomach up, right? And people would punch him in the gut as hard as they could. And he had this technique, and he could take a punch from whoever, Andre the Giant, whatever, right? He could take a punch. And so he was known for that. And so he was at a university, and this student walked up and sucker punched him out of the blue.
Okay.
Didn't even see it coming, didn't prepare. His appendix ruptured, and he died.
What?
Really?
Yeah.
Holy smokes.
Yeah.
So you think the market's going to pull a Harry Houdini?
I think there's going to be, it's not going to be trapped in a box and not getting out. It's going to be a sucker punch. Right?
Oh, wow. That's true, though. That's the way. That's because it's what the market doesn't know. It doesn't know that's going to get it, right? Like because everything that we are talking about is known information, and it's already being in some degree or another fully discounted into the price.
Yeah.
So
so what do you do as an investor?
Well, you got to risk manage your portfolio, man. Like, you got to. I mean, you could use options to do that. You can use alternative strategies. You got to have some risk management in your portfolio. If you're just levered long, my God, I mean, it's worked out well, but there's going to be something that's going to happen. Right.
It's funny you mention it's funny you mentioned the social media though, and how you don't know it's true. Like, I don't know if you watch Twitter on like a Sunday. I think Sunday is the worst day. They're all at home. And all the crematoriums, they're burning bodies in the Wu-Tang province. Oh, my God. I just couldn't take it. And they've talked them.
Driving trucks with big blowing steam out of there. I mean, I saw that video like 10 years ago. I mean, now it's in China.
That's right. They basically had convinced themselves, like I was watching it the other weekend, and I think they had convinced themselves that it was the S&P was going to open locked limit down. Like if you had got on Twitter and listened to these guys go on, and somebody told me the other day that they said, who you follow or what you see in your Twitter feed is a reflection of who you follow. And I'm like, well, I try to follow some bullish guys, but there doesn't seem to be anybody. Like it's kind of it's an odd thing. What do you feel about like how the world has changed in that, when you mentioned you were Gen X and you worked on a investment bank or on the research side at the same time as I did in the 90s and the 2000s. And now all of a sudden, we used to pass around information on trading desks, but now it's different. It's all on the Twitter and on the web, and it goes so fast. How do you think that's affecting markets?
Oh, I mean, it's well, okay, but good and bad. I mean, it's a good question. It's creating more volume, more liquidity on that, but it's but you're not seeing it in vol either. I mean, vol is kind of dried up, and so I don't know how that transcends into market movements, and are people actually trading on that stuff? I mean, Ben Hunt's got a really good algorithm that measures the drum beating on certain stories, and then he'll trade based on how big how much noise is being generated on a particular story or not, and it looks like it's doing some interesting things, but I think we're at the early stages of that. I don't know. I mean, there's so many people doing the same algorithms, the same quant-based trading. That's what's more concerning to me, and the trends going more towards herding into those areas than anything else.
Okay, so do you think that that's a function of like all the Bridgewaters and the Renaissances all looking at the same factors, and the fact that is that even though lots of guys get on Twitter and start talking about the end of the world and how they're burning bodies in China, the reality is that they're not moving the markets. Who's moving the markets are the Bridgewaters. And what do you worry about when you see their kind of preponderance of that kind of algorithmic trading?
Because they're not. How are they going to react to a sucker punch?
Okay.
Right. They're all doing the same thing, and what happens when that's
a liquidity thing. Yeah, that's
smart
always
beta, right? Smart beta. I mean, what the hell is that? No, seriously. I mean, and so I like ETFs, but there's some serious risks with some of the ETFs, right? You look at the HYG, for example, high yield bond index, right?
Yeah.
You're getting a whole bunch of inflow, and they got to bid up for all these crappy bonds. But what happens if it goes the other way around? They're going to sell the most liquid ETFs first, and you're going to be left. If you're not the first guy to hit sell on that HYG, I'm picking on the HYG because it's kind of it stands out there, or any other ETF, and it sells, and you're not the guy who hit the first button on the sell. What's left in your portfolio?
Yeah, no, that's some of the most illiquid markets out there.
So, Mark, give us some things that you kind of are convinced the market is missing, like some ideas of trends or trades or sectors or anything that you feel that you understand better than the market, and they're really missing this kind of opportunity.
Well, I think it's the mindset of people not understanding the transition towards this internet and IoT, the connectivity, Internet of Things, and they're not understanding the power of that and how it's influencing consumer behavior. It's influencing inflation. It's influencing business models. I don't think people really have a solid understanding of that yet, and its ability to scale. Putting like the Teslas and all that other stuff aside, but you look at Costco, right? Costco makes all of its money off memberships, and
everything else is a break even, right?
Yeah, the break even, and so they use the other stuff, extensive capital investment to make money off that. It took Amazon Prime, so it took Costco to get to where they're at. It took them like 15, 20 years. It took Amazon Prime 5 to get to the same number.
So how do you as an investor take advantage of that? And is it just a matter of finding the next Amazons?
It's not finding the next one because we don't know. It's looking at the existing ones and trying to get an understanding of the model, right? Getting understanding of.
You're arguing
like
that
Apple,
those who are thinking that Amazon's overpriced it actually might be cheap.
Maybe, but you have to ask yourself, how much of the network have they captured? Can they continue to deliver? So I mean, maybe there's risk on. I'm just looking at it from a different set of eyes because the traditional bricks and mortar approach is guys sticking to that value. Bricks and mortar are getting hammered. And it's time to say, okay, maybe am I looking at it wrong? Is it? I mean, there are areas of the market that just don't make any sense, like Tesla, for example. But you look at the Amazon model, look at Apple. Look at Apple compared to Goldman Sachs over the last decade. I mean, Apple's just been astounding on what it's been able to do. And they started off with the same revenue, and now Apple's 10 times bigger. So, and shows the share price. So.
Don't you though? Do you look at this and see shades of 99 like you were on?
No.
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 And tell me
it's
why not. Okay, so
different.
push back against that.
It's different. Smartphones. Go to next time you're out for dinner or at a mall. Look at it's not just millennials. It's like Gen X and look at baby boomers. Man, they're on Facebook. They're doing all of these. I mean, it's pervasive, and they're giving their data up. I mean, and that data is being used to do all kinds of interesting things that you can make money off of. So it's a lost lead model, and then they're implementing premium services, and they're scaling out at a tremendous pace, and that's strictly because of connectivity. It's just nowhere in the history of mankind. Have we advanced so far in the last 15, 20 years, more so in the last decade, and it's all because we're connected, right? If you're a young person,
so you almost would almost argue that all the dreams that we had in 2000, all the things that we said the internet was going to do, it actually has come true today, not 20 years ago.
Yeah, it's because of connectivity. We were too early in 2000. Right? Look at the data, the amount of data that's being created now because of that connectivity. Everything is connected. Just think about, watch around you. Look at Netflix. I actually had my most successful tweet ever. I had a retweet by The Rock. It had 500,000 hits to my website. Thank you, Rock.
Come on, really? The Rock?
Yeah, I did.
The Rock?
Yeah.
Well done.
I did. And I said he made a movie with Ryan Reynolds, a $123 million movie on Netflix, and I quoted that, and I said, blood, sweat, and respect. The first two you give, the last two you get. And it's the point is that it's The Rock made a movie for $120 million on Netflix, right?
Right.
So
the world's changed, basically, is what you're arguing. And too many people are stuck on old ways of thinking.
I mean, looking at bricks and mortars, and you're saying, well, how look at the revenue of this versus the revenue of this versus the market cap. But the revenue of one's having the ARR at doubling every year. Look at compounding. Just look at simple compounding at 5 or 6%. You start running numbers at 12 to 20 or 30% ARR. I mean, you're paying a multiple. What's the multiple of that, right?
Okay, so let's think about you're an investor. You're sitting there and you're trying to figure out where to put your money. What do you do? Obviously everybody's different, but there must be some things that in general you point them to. Why don't you walk us through just kind of some of your bigger themes that you feel are applicable in this environment?
Okay, so you need active managers in inefficient markets like Canada, and other markets like in maybe emerging markets or other where there's an ability to add value by doing thorough research and identifying Canada Shopify's of the world, right? There isn't very many of them, but doing some work from that standpoint is important. In the S&P 500, this is where it gets really tricky. Those four stocks, the MAGA, Make America Great Again, is what Trump said.
Yeah.
But those 4 stocks have contributed to 60% of the returns in the S&P.
It's crazy.
So so I mean, if you're an active
and they're
manager,
only they're a 15% weighting in the index, but they've contributed like half of the gains. It's like
60%. This year they're 75%. And so if you're a stock picker in the U.S. and you didn't have that in your portfolio, I mean, your results are terrible. So, and I like all of those companies. I really do. And so but I don't know which one's better than the other. It's just, and so I own passively the S&P. It's really simple, but it works. It works great. And then, I look at from a risk parity approach. I want to own lower correlated assets. So I do like the Bridgewater, not to their extreme, but I do like risk parity. I do like having some, treasuries in the portfolio. I do like, and that's been very beneficial for us. I do like having, a little bit of commodities in the portfolio. I do like having some real estate in the portfolio. So it's not rocket science, but I'm not making big calls on any particular segment of the market, but I'm constructing a portfolio that is based on different weights, can get me different target returns and minimize the vol. And that's all I care about. I really want to minimize that vol, because I mean, if you don't minimize that vol, there's a great. I wrote a report on it or a column on it, and I call it pattern of returns. And you can have 2 portfolios with exactly the same return, but dramatically different outcomes. So like $2 million with $100,000 a year draw, ending at $4 million, and one ending at $700,000 simply because of the pattern of the vol. And so, constructing a portfolio, like this is good old fashioned portfolio management. That this is the value of having an advisor do that work for you, or if you can try to do it yourself if you've got the capabilities to. Yeah. But it's really managing that vol, and not concerning yourself whether you should own an overweighted Microsoft or underweighted Apple.
Yeah. So listen, we're slowly running out of time, but I had to squeeze in the question beforehand is your views on the Canadian dollar as a fellow Canadian, because obviously that's a big portfolio decision, especially for a lot of people. So how much do you weigh yourself in a domestic currency? But what's your opinions on this?
Well, we're underweight Canada, so that means we have more USD, and that's been okay. Until that fiscal, like that trade that we talked about, starts to kick in, we're a petrocurrency. I don't care what you say, we are a petrocurrency. And until we start to see a rebound in those commodities, we're going to see it muddle along. The reason why the Canadian dollar has held up so long is because of the Bank of Canada. It's taken a much more conservative approach with rate cuts than other G7s nations, and so that's been very supportive to the dollar. But if you look at productivity, I don't think we as a nation at $50 oil can compete against the U.S. Much higher than 75 cents. It just doesn't work. We could get to par, but the oil's got to be there. We just don't have the productivity. I mean, there's all kinds of reports. Even what's her name, Wilkins? I mean, she had said that our productivity is lagging the U.S. I mean, hello. I mean, that's been the story for so long, and you can see that in the companies that we create. We just don't know how to compete. And because we use protective regulation, and we keep companies like Bombardier and SNC Lavalin in power or in business when they should be put, you should let the market do what it's going to do.
Okay, Martin, thank you so much for joining us. Before we leave, I always like to ask our guests one last thing, and it's if you could go back and talk to the Martin of 20, 30 years ago, what advice would you give them?
Play the long game.
Play the long game.
Play the long game. When you're young, you're only looking at 1 week at a time. Play the long game. There's a great book by James Clear, Atomic Habits, and so I'd really recommend it. And what it does is you're trying to change a habit or a particular goal, reach a particular goal, but you're not making big changes. You're doing small daily changes, and it's becoming a habit. So if I went to myself, I would say, okay, it was so exciting being in the energy space, and it was a great place to be. But I would tell myself to say, okay, what is this sustainable? Ask myself, am I thinking differently about this? and how can I reposition? And if I did that, and I think more people did that in Calgary or in Alberta, I think the province would be in a much different position.
Well, that's some great advice. Martin, where can people find more about you and your firm if they want to learn about you?
You can look me up on LinkedIn or our website, www.trivestwealth.com. We just did a big merger, so the website will still be live and forwarded on to a new site eventually, but that's the best way to reach us.
Well, thank you so much for your time.
And you can also follow you on Twitter, right? You got a good Twitter feed out.
Yeah, I have a little bit of fun. Absolutely. You can find me.
Well, The Rock follows you.
Well, no, he doesn't follow me. He just retweeted me. So I did try, and I can't push my luck. I got one, and that's one and done. So my Twitter handle is @mpeltier CIO for Chief Investment Officer.
All right,
great. Well, thank you very much for your time. We really appreciate it. Have a great weekend.
You too, guys.
All right, thanks a lot, Martin.